will keep on joining. So, welcome to our spaces, and would request your, starting view. O- on the results which you covered lately, and we saw various tweets from you. Those were very valuable. Point wise, you explained very well. So, our audiences would love to know more from you. So, over to you, Vineet.
Thank you, Prince. So before we start talking about any of the banks or specific names or the sector, I want to give a disclaimer. I am not a registered analyst. Please consider any of my opinions as my personal opinions. They are not a recommendation for the investments. They are purely for the educational purposes. I am here to give you whatever knowledge I have, just to pass on the knowledge. I cannot be compared with the best of the industry's banking analyst, but yeah, whatever knowledge I have, I can just share that. Uh, I can be having some positions in some of the banking stocks, so probably my view can be biased also. So please do not construe my opinions as a recommendation or anything which can, waver your decision on investments of your portfolio. So, guys, in general, before I go ahead and talk about the banks, we need to understand we are going into a different paradigm shift in India as well as across the globe, where the interest rates have been rising since past 9 months, and we continue with the recent commentary day before yesterday. We saw that Fed is not going to stop increasing their interest rates till they are comfortable and they are okay that the inflation is very much in control. So earlier the stance was they will be having a maximum interest rate of 3.4%. Just 2 3 days back that was the stance, but 2 days back Powell came and in the meeting he mentioned that they will go to any lengths, and they also gave an example of the past where they continue to increase rates till 8 7 8%. So this is the current scenario right now. Now, in order to give you context of where the interest rates are headed, we also have to look at Indian interest rates also, because though Indian inflation is not as high as compared to US inflation, where the standard used to be 1.5 2%, and they are somewhere around 6 7 8%. India has seen historically very high percentages of inflation, and with that kind of inflation, we are still not at the historic highs. But still, our interest rates need to be increased as and when Fed increases their interest rates. The main and prime reason is the flight of capital, because if we do not increase our interest rates, the risk on money which is invested in India, it will keep on flying back to US securities, US treasuries, where hence our exchange rate will be completely under stress, and which you would have seen that the current commentary from Powell has led to rupee breaching 80 also, just 2 days, within 2 days. So if they continue to increase rates, RBI would have to increase the rates. Otherwise, rupee will have a major downslide, and hence we would have to increase the interest rates. Now, what are the repercussions of increasing those interest rates in Indian economy, in the banking sector? That is something which we need to look at. For example, in past 6 7 9 months, RBI has taken most of the liquidity from the market, considering almost quantitative tightening in the US and interest rate increasing. RBI also changed its stance, and they took the paddle off from the accelerator, and they said, okay, we would also have to take some liquidity off the table, and they also started increasing repo and reverse repo with CRR and SLR, etc. with these repo and reverse repo and CRR and SLR, etc., they are the measures from RBI to decrease the liquidity from the system. So primarily when we say system, it means banking system. So when they have taken the liquidity off the table, it puts a lot of pressure on loan disbursals and the deposits. So what we have seen in the recent quarter is two of the major banks, which is ICICI and Axis, has actually lost their deposits in the last quarter, and that is primarily because market में liquidity इतनी dry हो गई है, 90% of liquidity has been drawn down from RBI. अर्लियर जो पहले SLR और CRR जिस लेवल पे होते थे वहां से 2% हाइक हो चुका है. So when you say CRR, it means that whatever deposits you have, as a percentage of the total deposit, you have to deposit a percentage to RBI in the liquid instruments. Similarly, SLR is also similar function. You have to have a statutory liquidity in the RBI bonds, etc. So the return on them, they are also getting less, and if they want to raise further money from the market, that is also coming at a higher price, which is reverse repo, and repo rate has been increased, and hence the market में जो competitiveness है towards seeking the money for the loan, etc., same set of buyers are looking for a less amount of money for the loans. So eventually the interest rates start building much higher as compared to what RBI has increased. So as and when this liquidity keep on having a dry tap, RBI keeps on having this dry tap of liquidity. Uh, what I can foresee personally is the deposits are going to take a huge toll in the industry. Either the banks will have to fight for deposits, especially tier one banks, which is ICICI, HDFC, Kotak, and Axis. They would have to fight for the deposits, because what is happening is tier 2 banks like IndusInd, IDFC, and the likes of AU Finance, they are all giving saving bank account at 5.5%, 6%, 7%. So they are able to get fast deposits easily, but those are not sticky deposits, I must say, but they are still able to get deposits. However, ICICI, HDFC, if they want to garner more deposits in the times to come, because CRR is so high, even if you get deposit, you will also have to furnish some money in CRR, which is again money off the table. But if you raise the deposits for HDFC and ICICI and Kotak is already at a high rate. So let's take out Kotak. So HDFC and ICICI, if they have to increase the deposit rates in order to garner the deposits, they will get a hit on their NIMs. So I feel that the larger banks here are at a very big disadvantage right now, because most of the tier 2 banks are already having a high cost of fund. So they are okay to give saving deposits at 5.5%, 6%, 7%. And the likes of HDFC, where the deposit base is so huge, somewhere around 14 lakh crore, if somewhere around 16 lakh crore. So even if they raise deposit rates by 50 bips, it hunts down their NIMs. So that's the challenge which I foresee is going to come. Before we go and deep dive into the numbers of last quarter, what has happened, this is what is my concern going forward, that the larger pack of the banks will have difficult time in getting the deposits. However, the smaller banks can give a run for the money, because what is happening is when the credit cycle is at working at 14% and the deposits are growing at 7%, eventually there is going to be a deposit war. And with HDFC Bank and HDFC Limited merger coming, there is a deficit of around 2 to 3 lakh crore of deposit in HDFC merged entity. So they will eventually start trying to get deposits at a faster rate, which will create upheaval in the whole banking pack in next 2 years. But again, this is a time to be seen. We have to see it when it happens, how it unfolds. I can't say for sure how it will happen, but my opinion is that probably there is going to be some repercussions on the deposit side. Uh, let's go down to the result side. Last quarter, as mentioned, we have seen ICICI and Axis losing some deposits, which was a surprise to me. Though everyone compares, year on year in the banking space, I specifically do not like to compare year on year numbers in a banking space, because what happens in banking is for last 4 quarters there is a sea change in the environment. So last June was a COVID quarter. Last June was a different liquidity environment. Last June was interest rates were very different. So in banking, in 4 quarters, life changes altogether. So I always tend to prefer for any accrual basis business. For example, loans continue to give interest quarter on quarter, which you have disbursed. So an incremental loan every quarter will give you an additional money. So that is why I look at quarter on quarter, because this is an incremental kind of business. So that's my preference. I look at quarter on quarter. That's my reasoning also. So quarter on quarter, ICICI and Axis have lost the deposits, primarily maybe because they didn't timely raise the interest rates, or whatever is the reason. HDFC is still better off. They did made some sort of gains in the deposits, though it was in terms of percentage, because the base is so high, somewhere around 16 lakh crores. The base is so high, even 44,000 crore worth of deposits were merely around 2.53% quarter on quarter, which is not a great number to be very true. Last December quarter, March quarter, they had a 8% growth. So HDFC still garnering most of the deposits, but ICICI and Axis losing. Kotak had a very tepid deposit growth of 1.5%. IndusInd was somewhere around 3%, which they have been doing since past 3-4 quarters. So IndusInd was at par with whatever they have been doing. IDFC being a non big bank, and it's one of the different stories as compared to stable banks. I should not compare IDFC with all these banks, but however, since its book is large enough, it has 1 lakh crores of book. So I would keep it in the same bracket and will try to compare it, because this is what most of the market analysts do, and they try to compare HDFCs and the likes of Kotak and Axis with IDFC. However, they are not comparable in my opinion. But still, for the sake of the analyst community, IDFC still did very good in terms of deposits. They increased their deposits by 10.5%. But again, IDFC is offering around 6% on the deposit rate. However, IndusInd is offering around 5.5% on the deposit rate. So their growth is more or less quick money sort of deposits, rather than HDFC and ICICI, because HDFC's deposit would primarily be coming from the salaried accounts and the long term accounts which they have been having. So their deposit growth is more or less very sticky. However, if IndusInd or HDFC tomorrow comes and says, okay, we want to decrease the deposit rates, probably they will see a flight of deposits to the larger banks. So that is my opinion. I'm sure everybody is entitled to their opinion. This is my opinion. Please do not put me online if it doesn't happen. But this is what it is today. It looks like today, because all the banks, all these tier 2 banks are trying to have that kind of stable deposit base, where they can see and have long term client relationships and can have a sticky deposit base. That's on the deposit side. On the advances, again, there was one bank which was an outlier. The credit cycle is turning, and almost every bank is showing a good credit growth. As I mentioned, I am expecting 14-15% type of credit growth for this financial year, for the full year, and deposit growth to be very tepid, around 7 to 8%. But in line with what the credit growth I am expecting, the only one outlier bank was Axis Bank. They actually decreased their advances, which was a surprise to me, because the whole industry is moving towards higher credit growth trajectory. I don't know how they ended up losing deposits as well as losing loans. So that's where I don't know what kind of strategy they are following, but they still have to come up with something which can actually help and create some value out of it. So in terms of loans, ICICI Bank actually posted a very good number on a big base of somewhere around 8 lakhs. Um, uh, they posted somewhere around 4.3% growth quarter on quarter. Somewhere around 36,000 crores worth of loans were added in their book. However, they still lost a good amount of deposits, somewhere around 14,000 crores. So that's the major challenge there. In terms of HDFC, they had a very small growth of 2% in the loan book. Again, outlier was a small bank. IndusInd Bank and IDFC were outliers because of small base, and then they have been aggressively trying to increase their loan book. But to be very true, again, I am repeating myself. IDFC is not a bank to be compared with almost all other banks, because it's a turnaround story. They are changing their business mix, and their business model is also very different as compared to other banks. So if you put it in the same basket, probably IDFC is not the right basket to be compared with. In terms of NIMs, almost all banks, all top tier banks, they were having a stable NIM. Kotak actually had a very good NIM expansion due to increasing interest rates. However, IDFC was a loser there in the NIMs, because it was primarily because their loans, whatever V. Vaidyanathan says, is their majority of loans are fixed interest rate loans with a maturity of 6 to 8 to 12 months. So they cannot pass on the hike in interest rates. So hence their NIMs have fallen from somewhere around 6.3% to 5.9%. But by the industry standard, if you see HDFC, ICICI, and Axis and IndusInd, they all operate in the range of 4 to 4.5% NIMs. However, IDFC on the other hand operates above 5.5% NIMs, which is a different business altogether, which I have been saying it is not comparable. So comparing a 6.3% NIM with a 4.2% NIM business is a very different story altogether, because their loan mix is different, their strategy is different, and their borrower profile is very different. Cost to income ratio, again, last quarter, what happened was, since interest rates were increased, most of the banks have to have SLR, etc. They have to maintain some exposure to the government bonds. So when interest rates are increased, what happens is bond yield increases. When bond yield increases, it means bond prices are going down, and which means the value of the bond where you have invested goes down. So as per the accounting standards, you have to take a mark to market loss on the value of the bond, and hence your treasury income and other income in the income statement of the bank takes a hit. HDFC, ICICI, and Kotak had a major hit in terms of the treasury losses. Kotak, in fact, had the biggest percentage-wise loss out of operating income, which was 30%.
was wiped off from the profit before tax. However, HDFC had a 10% fall or a hit in terms of profit before tax due to mark-to-market losses. So the quantum for the Kotak was higher, and hence all the ratios for Kotak have been skewed because of that. Kotak actually saw a cost to income ratio increased from 47% to 53% in one quarter, which is a 6% increase in one quarter, which is again it's a one-off in this quarter. Probably next quarter also we will see some aberration because of again increasing interest rates. But once interest rate cycle calms down and it stops increasing, everything will normalize, because these are all notional losses, to be very true. If they keep the bonds till maturity, they will not have to book any losses actually in real cash terms. So, looking at other things, profitability, etc. Again, this was all reflected in M2Ms being impacting all three major banks: HDFC, ICICI, Kotak. Kotak being one of the hardest hit. They saw a major decline of 24% quarter on quarter in profit. Hello.
Yeah, so Kotak actually saw a major decline in quarter on quarter profit before tax, which is around 24%. However, HDFC had a 7% fall, while ICICI was almost flat. Uh, Again, the tier 2 banks, IndusInd and IDFC, posted great set of numbers because they are on a growth trajectory. Their NIMs are also higher side. Their their NPAs are also on a down cycle, though NPAs in general have been coming down post COVID for the whole industry. So, as a general overall industry, banking space as a space, NPAs have been falling across the board for all the banks, not only private but public, but
The government banks also. And when we say NPAs are falling, it's actually falling because the COVID effect is waning off, and hence it is normalizing to what it should be. So hence, almost all banks are coming out of woods. You would have seen that most of the past 2000 point rally in Nifty also was led by most of the banking back sector stocks. But again, this is all a factor of the interest rate cycle and the NPA cycle. Uh, what uh, what we envisage, or what I envisage, is most of the banks will see a better ROA profile going ahead. Last quarter, since usually quarter one, when the weights are assigned. So before I go into ROA, every first quarter of the year, RBI assigns weights to different loan categories, and when I say weights, it means risk weights. So your capital adequacy ratio, etc., are decided based on your risk weights given to any loan. So capital adequacy is something which actually limits the bank, how much it can grow and how faster it can grow, and it also safeguards a bank from any potential mishappenings in the sector. So most of the banks, you will see capital adequacy ratio falling in Q1. That's primarily because the weights are reassigned in first quarter of every year, and we will see a normalized capital adequacy ratio increase when we see higher ROE and ROA going ahead, because NPA cycle is anyways coming down. So coming back to ROA, since M2Ms were high in this quarter, HDFC, ICICI, Kotak, they all saw a falling trend quarter on quarter in ROE as well as ROA, because in actuality they posted some losses. However, those were notional losses, but again it is counted as losses because you when you compare your ROE and ROA, it is all based on your whatever profit you are posting on the book. So both HDFC, ICICI posted a 2%, close to 1.5, 2% fall in ROE. Kotak, however, as I mentioned, the amount of M2M was somewhere around 30% of their profit before tax. Hence, they had the biggest fall in ROE, which is around 4.5%. And similarly, the ROA was also much lower as compared to other banks' fall. IndusInd IDFC, again, an outlier. As mentioned, they are smaller banks working towards higher growth trajectory, NPA cycle helping them, NIM cycle helping them, interest rate cycle helping them, lower base helping them. They are growing faster than the industry. So yes, net they are posting good numbers, but they are not at a scale where HDFC, ICI, and Axis are operating. So we have to discount that also. Capital adequacy we have already touched. NPA and the NPA cycle has been turning. I recently read somewhere that in the next cycle, whenever the cycle turns, probably SME loans will actually post a higher NPA numbers. That is what the industry is envisaging. I feel it depends on what kind of credit worthiness your SME loans have, because what happens is what kind of process you are operating on while giving a loan is really important. If your process of disbursing a loan is based on a cash flow driven analysis and with appropriate security in place, the when the tide turns, the probability of that loan going bad or sour is far lesser as compared to an un not better credit wise quality and what people call it as subprime. So I would say yes, there can be some issues coming forward in future whenever the tide turns. But right now, the tide is not turning, because what I see is the credit cycle is starting in the corporate side. SME has already been picked up 2-3 quarters back, and they have been getting loans easily. Retail loans are pretty much growing at a good pace of around 20% annually. So the only thing which was lagging was the corporate loans. That was primarily because on the capex cycle, which is also started turning this quarter itself. You will start seeing most of corporate loans being dispersed in September quarter, and then higher loans in December and March quarter. So when this cycle actually starts turning, all the banks, financials will see a lot of upside in terms of operating leverage, because most of these banks are working on an operating leverage business. Almost all banks are highly operating leveraged in terms of cycle turning. They will see multifold, specifically the smaller banks, they will see multifold increase in operating profits. However, again, the deposit side, which I mentioned earlier, can pose some risks for the larger banks. In the smaller banks, I feel specifically IDFC and IndusInd and the likes of IDFC can play a very good catch-up game in the market. On the PSU side, I still feel people are very bullish. Many people, many analysts, many PMS managers are very bullish on PSU banks right now, because the cycle is turning. NPAs are all-time low. They are sitting on a very large books. Hence, operating leverage is going to be high for them.
But when market gives them evaluation, they are actually discounting that their underwriting is not great enough, and hence whenever the tide turns, that bad underwriting is going to haunt them at any blip. So that is why they are not getting the valuation also. So if you look at the likes of IDBI, look at the banks likes of PNBs and other PSU banks, they are not getting the kind of valuation which even IndusInd or Axis commands. They are actually trading at a discount to book value because market sees them, their underwriting to be not at par with private banks. However, people who are still bullish on PSU banks, they can be, because if a zero point 0.4 book value becomes a zero point 0.8 book value, it still is a two and a half bagger considering accretion in book value. However, I feel that if tide turns, it's a risky bet for me. I would never go for it. I would still want to be in one of the safest spaces where I know the credit quality is better, and the likes of HDFCs and ICICIs of the world. ICICI has seen, I've seen a lot of people, saying ICICI is going to be outrunning HDFC by far through and through. However, people have to see that in past 15, 17 years, I have seen this story at least three times in my life, where people keep on saying that HDFC is going to surpass ICICI is going to surpass HDFC this time. But we have to see that yes, ICICI stock has given good run up. I completely understand it was a beaten down stock. There has been re-rating. However, can it outrun HDFC? It is something to be seen in the future. This cannot be commented today. And in order to outrun them, they have to outrun in for next 10 years. Then they can outrun them. Because if you look at the book of HDFC and ICICI, HDFC is actually having a deposit base of 16 lakh crore, while ICICI Bank is having a deposit base of around 10 lakh crore. With deposit war coming, do you think that 6 lakh crore of deposit can be garnered, and while HDFC will keep on sitting idle and not garner any deposits? That is something to be seen. Again, when you look at loan side, HDFC has a loan book of 14 lakh crores, while ICICI has a loan book of 9 lakh crores. There is a gap of 5 lakh crores. I mean, how on hell will they match this up? How can they outgrow it? It is very difficult for ICICI to catch up HDFC. However, considering the merger happening, HDFC is going to become another behemoth. It is very, very difficult for any bank to actually outsize and outrun them. However, they will continue to grow on a bigger base at a very smaller pace, but they would still continue to grow bigger. So, growing from a 16 lakh crore book to 32 lakh crore book is far, far difficult than growing from a 1 lakh crore book to a 2 lakh crore book. So people have to understand this. ICICI is a smaller bank, hence it has given a better returns. Also, there is a turnaround story in ICICI underwriting quality. There is a turnaround story in the management. That's why so far they have given a good outsized return. But after a scale, every bank will have to see whether it can grow at the same pace or not. When I always use this term in this industry, there are small ants, there are small dogs, and then there are there are horses, and then there are elephants. So dogs can become horses very fast, but can horses become elephants faster? It is not possible, because elephant will remain an elephant and will continue to walk with a small pace, but will continue to grow far much. In terms of actual numbers, will continue to grow faster than a horse. However, horse, how fast can it fastly grow to become an elephant and then compete with another elephant? That's something very difficult. However, a dog can become a horse very fast. It is a very easy run for the dog. But from there on, becoming horse to elephant, it becomes very difficult. So hence, I am very bullish on tier two, tier three banks. Tier one banks, yes, they are good underwriting. They are a good book. Money is safe, etc. Hence, risk is less. But please do not expect them to, give you a last 20 years run which they have given as a similar run of next 20 years, because as you grow bigger, you cannot outrun the growth of your whole India. I mean, you cannot outrun the growth of India. So that is what is my take on the whole banking industry as such. One more opinion on IDFC first. People compare it with tier one, tier two, tier three banks. It's not comparable. Their business model is very, very different. Their NIM profile is very, very different because the kind of loans they disburse. They are somewhere in between Bajaj Finance and the HDFC Bank. So they are trying to become some portion of their loan book is tilted towards Bajaj Finance. Some portion of their book is tilted towards housing finance. So their NIM is also in the middle of these two. Bajaj Finance operates at an NIM of around 10-11%, and HDFC operates at an NIM of around 4.5%, 4.2%. So if IDFC starts doing 4% NIM, they will never make money because their cost of funds and etc. are very high, and they cannot make operating profits also because they are a new bank. They cannot be compared with other banks. However, if Bajaj Finance starts doing HDFC business, they will also lose money because it is not their business model. Their cost of funds is too high. So I would never compare IDFC with any of these banks, but considering the whole analyst community pits them against each other, that's why I kept it like that. So if anybody is having any opinion, I'm all open ears to it, and any questions are more than welcome, Prince. And that's it from my side. It's already been 40 minutes I've been speaking. I'm more than open for all the questions.
Yeah, Vineet, that's very elaborately you told everything minutely. Yeah, that's really nice. So, guys, the floor is open for questions. I see few questions in the comments as well, so I'll be taking those. And in the meantime, if any of the audiences have any questions or any input, or if they agree or disagree with the views of Vineet, we are open for a healthy discussion. So you can send in a request, or I'll take your request. So Vineet, I'll make it simple for our audiences who have just joined the market, or maybe their experience are not up to that level that they can evaluate banking sector so easily. So my question would be like how they should go about investing in banks and financials. So what should be, I mean, not in the form of buy sell recommendation, but again, financials is a big space. So how one should go about investing in that space, and then we move on to other speakers for their questions. Yeah.
So, Prince, cautionary tale, people who do not understand banking, they should never invest in it, because what happens is people start losing money at the first blip, because once you do not understand, you do not have the conviction at the first place itself. So banking is a very leveraged business. In the COVID time, we have seen the drawdowns of around 50-60% in some of the largest banks of our country, and even 70-80% in the tier 2, tier 3 banks. So, and we have seen some of the financial institutions losing and wiping out shareholders' wealth in the past also. So, people who do not understand banking and financial space, number one, stay out of it. Do not invest. If you want to invest, invest it through some mutual fund which is focused on the financial space, etc. If you cannot read them, if you cannot look at the numbers, etc., don't invest. If you want to still very persistent, I just want to have one or two banks in my portfolio, then probably go with the leaders. Specifically ICICI, HDFCs, Kotaks, and Bajaj Finances of the world. They are probably one of the most systemic risk banks. If they go kaput, probably government will try to save them. So that is the way to look at it.
Right. We have Kamlesh with us. Kamlesh, you can unmute and ask your question or maybe any input.
Hello.
Yeah, Kamlesh.
Yeah. So I had a question on two questions basically. So one on we're seeing credit growth picking up as Vineet said it's going to be 13 to 15% this year. Are valuations running ahead of fundamentals in this space? So that's one question. Because if you look at ICICI or HDFC, ICICI is inched up and it's close to HDFC valuations now. So now will it be earnings growth and returns, will it moderate? So that's one. Second, on IDFC first, uh, the credit underwriting, it's a retail story here, at 5.8% NIM. Is it seasoned enough, or will there be surprises in terms of underwriting, because it's trying to grow so fast, and there might be surprises there, and should there be caution here in the case of IDFC first?
Okay, first things first. On the credit side story and what's going to happen and the valuation side. See, the valuation is forward-looking always. They factor in the kind of growth which we are expecting. So, when you say HDFC used to trade somewhere around 4 times book value when everyone was looking HDFC to grow at 20% year on year for next 10 years. So that time HDFC was always expensive. It was always 4 times, 4.5 times book value. It always delivered on the same parameter of 20% growth. However, given the size of the bank now, people have started moderating their growth prospects for HDFC, and hence there is a moderation in the valuation also, which is the price to book has come somewhere around 3.5%. Uh, ICICI, on the other hand, was on a beaten down valuation because of past history and corporate governance challenges in the past. However, with the new management, the underwriting, etc., has changed, and that's why there is a revaluation on the upside from 1 time, 1.5 time book value to somewhere around 3 times book value. However, by any standards, it should not be trading at 1 time book value in the first hand, because just because some CEO has done something and you never know what is there in the book. That's why the sentiment was so negative at ICICI, that people were bothered that there can be more, dead bodies in the book. That's why it was at a beaten down valuation. Now those things have gone past. They have seen the COVID also. The book is all cleaned up. That's why they have been come. They have their valuation have come to the standards of the likes of ICICI, etc. So going ahead, if the bank which will have a higher growth potential, which can see outsized returns, will definitely have a higher price to book. That is my opinion. When I say higher price to book, it also means not only growth, a higher return on equity, higher return on assets. It's a blended valuation which you get in price to book. So considering your NIMs will be good, your loan book will be good, your underwriting will be good, and your ROE will be good, and ROA will be good, yes, you will get a good price to book. But if any of these parameters fall, price to book reflects everything. That's my take on the valuation. On the IDFC side, again, Kamlesh, I think I must have said 3, 4 times in the session itself. IDFC is not comparable with the standard banks on the industry. They are trying to create a niche between Bajaj Finance and the banking space. When you compare their NIMs with HDFC and ICICI, again, this is what CNBC and anchors also say: your NIMs are too high. Why are you doing subprime loans? So this is the classic. I'm quoting V. Vaidyanathan here. V. Vaidyanathan himself says If my NIMs are high and I am doing subprime, what is Bajaj Finance doing? Its NIMs are 10%. Are they also doing subprime? Because retail loan as a product has a high turnover. It gets repaid in 6 to 8 months, and hence you can use the same money and churn it again and create further ROE out of it. That's why the returns are NIMs are higher. So it all depends on the kind of loan profile which you're doing. Or they are also doing home loans. IDFC is also doing home loans. However, Bajaj Finance is completely on the consumer finance, etc. That's why their NIMs are on the higher side. So as I mentioned in the session also, IDFC is somewhere between Bajaj Finance and the other banks. They're trying to be sticky with their customers by introducing home loan products, etc. But they are also I'll also give you an example. If whichever city you are in, you can visit any white goods, consumer goods, durables store, maybe Reliance Retail or the likes of Chroma, and find out the person who gives EMI. You will only see two representatives, either Bajaj Finance or IDFC. There is no other bank sitting there. There is no other employee of any other institution sitting there giving out retail loans to any of those customers. That is the business model they are following. That's why their NIMs are high. That's why their cost of funds are also high. Probably because they have been doing different kinds of strategies to gain as much as loans as possible. They have been sourcing loans from DSS also. That's why their cost to income ratio is also very high. So again, this is a not IDFC is not a comparable bank. Let's not compare it with HDFC. Let it carve its own niche. Then let's look at its numbers individually from the banking space, because this is not a run of the mill bank which is getting created. We will see after 5 years what has been created. It is still being created. People are very apprehensive about it. Media is very apprehensive about it. I in fact saw CNBC main anchor Lata saying last quarter, why is your NIM so high at 6.3%? And this quarter she mentioned, why did your NIM fall by 30 bips? When you are operating at 5.9%, you are still higher than most of the banks. Then you are not questioning why are you higher. You are questioning why are you coming down. So point is, analyst community will see it in their own eyes. You have to be very rational with what you are seeing. Comparing it with the rest of the banks is right now not a right choice to be done. They are carving their own space, and hence should not be compared.
Yeah, just one additional question here. Obviously, I don't want to compare IDFC first with ICICI or HDFC. The borrower profile is different, the NIM profile is different, the riskiness of lending is different. And if you look at Bajaj Finance, a 10% NIM translates to 3% ROA or 3.5, 4. IDFC is targeting that, with a 6% NIM, trying to target a 2-3% ROA. Now, my question is something else. Since we are in the beginning of a credit cycle, and we think this is going to be secular for next 2-3 years because there's been no credit growth for a long time. Capex revival is on the horizon. Is it a prudent strategy to go below the larger banks? Because something like if the music plays for 3 years, can we go down on quality and earn money? Because there are PSU banks, there are MFIs, there is IDFC Bank, which are not valued so highly. And can we ride the curve and earn outsized returns than compared to ICICI Bank or HDFC Bank?
So Kamleshi, I am not in a position to recommend anything here, but I am entitled to my opinion. My opinion is again, it depends on person to person. Depends on your risk averseness. If you are very risk averse, you will try to ride the wave with the tier one section. However, if you are mid-risk taker, you can go with tier two. If you are a high-risk taker, you would go with a MFI kind of an institution or a very small bank like a federal bank or etc. or maybe an RBL. So again, depends on the risk appetite. What do you want to perceive? What if in March government comes and says, no, 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 there is something wrong with ECLGS, something wrong with Mudra loan, what will you do? So you never know. It has to be seen quarter on quarter. We cannot envisage what's going to happen in 2 years. It is very much a very dynamic industry which changes due to government policies every quarter. So be on toes if even if you are investing in the likes of tier ones.
Okay, thanks, Vinny. Thanks, Kamlesh. Yeah, Pramesh, you can unmute. Yeah. Anything else, Kamlesh? Okay, we are good. Yeah, Pramesh. Pramesh, you can unmute and speak. Okay, we need in the meantime I take a few questions from the comments and DM, right? So we have one question from Kuldeep. His question is, if credit cycle is picking up, if someone wants to track which sector they are lending, or are these sector able to return money? It's just about how to track underwriting of a bank. Is it all about management or loan mix?
So it's both actually. Management and loan mix both matters. Again, if I don't want to comment on any executive of any of the bank, but if any bank CEO gets pally with any of the big large corporates and relaxes some rules for them, how will you know? How will a person know that the biggest exposure to any of the group is one bank? It because they do not disclose their client base, etc. It's always better to look at granularity of the loans and how much exposure does the top 2 or 5 or 10 customers have on the book. Most of the banks disclose that top 10 customers exposure, etc. So if the bank is more granular, then probably it's one of the safest strategy. If the loans are lumpy and they are giving 10% of the loan book in top 10 customers, then probably it's a risky strategy. If two out of them goes bad, probably you will lose around 2-3% of your loan book in just two corporate loans. So that is the way to look at it. Credit cycle going up. I understand many banks will lap up corporate loans. HDFC specifically is going ahead with a lot of corporate loans. You will have to be very objective in looking at what they are doing. Keep a sharp eye on their numbers, what they are dispersing and where they are dispersing. Government specifically has given out, has been recommending to give loans on the infrastructure space now, and they are ready to give some lower risk weights also. But again, depends which bank take it and which bank lap it up and tries to increase their ROE based on that. Uh, Credit underwriting is the main thing here. These 2 years we can see huge uptick in the credit uptake, but next after that, if a bank has not done proper underwriting, we can see a tough time.
All right, Vinny. So Chetan, you can go next.
Sorry for what?
You sent the speaker request. I think you have
Oh
some
yeah, yeah.
solution or question.
I'm happy.
Yeah.
No. So I'm a financial expert. I've invested in almost every private sector bank as well as SBI, Bank of Baroda. For the last 2 years. I was just hoping, like, if there are any complex questions about the credit cycle, I'm happy to take them.
Thanks, Chetan. If it happens to be, we'll come to you. Yeah, Neil, you can unmute and ask your question.
Yeah, thanks, Prince. Vinith, one question is on the current wholesale lending business for the banks or NBFCs, because ever since 2017 the wholesale lending was at peak, and after the IL&FL's crisis, everyone started to bring down their wholesale book. Every presentation I see, they said we are reducing wholesale and we are increasing retail. That's been the story of IDFC West Bank, PEL, IL, um, L&T Finance or whatever. So is this something now to start looking at into the wholesale, or it is still something to avoid? That's my question. Thanks.
So again, Anil, taking the whole basket of wholesale book out of the banking mix will be a mistake, if I have to say, because most of your fast growth will actually come from wholesale book. But you have to be very prudent when you are growing your wholesale book, because you have to be in good names, you have to have a good underwriting, you have to have a good security cover, because wholesale book does give you good growth, but it does not give you good NIM. And retail, however, is a very granular growth with good NIM, but difficult to grow. So my take is, yes, there should be a healthy mix. HDFC has a healthy mix of around 55% corporate, 45% retail, while ICICI is more tilted towards retail. Probably HDFC will continue to grow the similar fashion which they have been growing, and ICICI will continue to focus more on retail. Smaller banks like IDFC, they have burned their fingers because they were not expecting the whole loan book of wholesale, which is infrastructure loan book, is going to go bad, and hence they had a very bad 2.5 years of writing off all the bad loans. Now that they have gone out of the cave and the tunnel is almost over, they are saying that we will not grow it further. That's their strategy, to be very true. I am not saying it's a bad strategy, but let's see in future what it holds. Sometime in future, because last 2-3 years back they were not saying we will do home loans, but after I think 3-4 quarters back they started saying we will do prime home loans because we want sticky casa. So strategies might change in future. For the time being, they are good with whatever strategy they are holding. Similarly, HDFC is also good with whatever they are doing, because this is their forte. They have been doing it since long. If you look at the news also, any bank or any NPAs which come out in news, you will hardly see HDFC Bank's exposure in any of them. That's because they have a good underwriting skill and they know what they are doing. So again, even if wholesale book is increasing, you have to be very prudent while underwriting it.
But I think if you look at how the ICICI and IndusInd Bank strategized, in the recent slowdown period, they actually created both growth engines. Especially ICICI Bank, they focused not only on their digital API stack and their digital capabilities, but they also showed up their corporate underwriting, and they made sure that they are positioned very well. So that's why ICICI Bank over last winter became like the primary, the number one bank that investors wanted to invest in, and HDFC became number two. So the swap happened because ICICI started showing leadership both in retail, digital, and corporate as well.
Yep, thanks for that. Yeah, can I ask a follow-up specific to a stock, maybe Piramal Enterprises, because today is ex demerger and the market has given it as 1050 as a price, well below the price to book. Is it still undervalued? What is the outlook for that particular stock?
I personally hold Piramal, since 700. And the reason being that it was grossly undervalued at 700, but also because Mr. Piramal is such a good capital allocator. So you can already see what he has done with DHFL. It's going to bear you 3,000 crore of EBITDA. Or
Then
not
sorry
EBITDA,
to
sorry,
come
but
in between. We'll be keeping today's talk to banking and financials only. So Anil, sorry for that. And
okay. No, but
okay,
Piramal
financials.
Finance
Okay,
is
okay.
actually
Sorry,
like
sorry.
one of
My bad.
India's
My bad. My bad.
large.
Yeah.
Yeah. But actually, that's the point, that Piramal is heavily, grossly misunderstood, right? When the stock goes down, people forget that they have a pharmaceutical arm. And then, when the stock goes up, people, also become very risk averse, obviously for good reasons. But with the demerger, I think investors now will be able to pick, which side they want to go in, whether they want to go into the Novartis or other acquisitions that Mr. Piramal has done and go into the pharma space, or whether they want to go into the real estate lending and the NBFC and the housing finance book that he has now set up with DHFL acquisition. But if DHFL starts giving what do you call it, the expected 3,000 crores per year, then obviously it will still be very undervalued, the Piramal finance part. I think it's just a matter of one quarter when those DHFL exposures will start giving that income, and all the write-offs have been done last quarter, so you'll be able to see if actually that is bearing fruit. But it is slightly undervalued. It is not like as undervalued as it used to be when it was 700. So it's probably 20-25% undervalued. But the DHFL boost itself, can lead to analysts thinking that this is massively undervalued. But we have to see how much boost he can get. And there's a difference between Mr. Piramal's style of collections and the DHFL group style of collections. So that could also show some extra returns from the corporate book that they got for free. So they acquired a corporate book on top of the retail book from DHFL for free. So that could be an extra return that investors could get. So there are quite a few points to watch out the next results. But yes, it's a great company to own for a long term.
Thanks, Chetan. So Vineet, any input, or shall we move on to next question?
So, I don't want to give an opinion on Piramal's finances business because I have not heard very good about their underwriting capabilities. Specifically on DHFL book being acquired, I am also not very sure how clean it is. That's why market is giving them a huge discount. That's the main apprehension which I have. Again, I specifically look at companies who have book value on the upwards of 80,000 crores and above. So if Piramal is not there, then probably I'll not be even looked at them.
Right. So Pankaj, you can go next. You can unmute and ask your question. Okay, Karthik, you can unmute and you can ask.
Okay, thank you, Prince. I would like to. Can we discuss something related to gold finance also here? Because like now, like both Muthoot and Manappuram is going down, and even their yield also percentage also have now is coming down. Earlier it was around 21, 22. Now it had come down. So what is your idea about their long term aspects?
Yeah, Vineet.
Though specifically, Karthik, I do not track gold loan business because it is a very localized and high OPEX business. Specifically for the yields going down, because most of the smaller entities and banks, smaller entities like IFL Finance, banks like HDFCs of the world, they all have started saying we will enter the gold loan again, and most of them have actually started doing it. But to be very true, in past, what has happened is they jumped into the gold loan wagon, and they never thought that it will be a difficult business because see, for a gold loan to be approved, these Mannapurams and Mathoots of the world, they disperse you the loan within 2 to 2.5 to 4 hours. And if you go to a bank, try to get a loan in 2 hours. You will see the plight of the life. So, coming from a bank perspective, getting a loan within 2.5 4 hours, it's a huge task itself. They need an SAR on the desk. They need to have everything in place for the gold loan because it's a physical asset. It needs to be essayed and transferred to a proper safe place. Also, most of the banks try that they should have a bank account with you. Bank account opening itself is a process in some of the banks, while some of the banks open the bank accounts online very fast, 20 30 minutes, 1 hour of job. However, I still see a lot of disruption happening in the gold loan business. That's why Muthoot and Manappuram are trying to capture the space through decreasing their margins. The margins are under pressure because of the competition. But I don't think that competition can do what Manappuram and Muthoot has done in next 2 years because surely because of the kind of operations and the scale of operations it is required. It is a very localized business. Banks are always centralized business. Credit writing, underwriting, etc. Goes to a central team. It gets approved, etc., and then you get the loan. However,
Yes.
gold loan is a centralized or is a very localized business.
And if I can comment, this is exactly why Manappuram and Muthoot have been struggling in terms of stock price for the last 3 quarters. 3 quarters ago, Manappuram raised a very big red flag in one of their calls. When they mentioned, and also maybe in their presentations when they raised that there's a small private sector bank in South India which is competing very aggressively with us, and that bank obviously was Federal Bank, and the rest is history. So Federal Bank was very aggressive competing with Manappuram, in the last 3 quarters or 4 quarters, maybe 3 quarters ago they started seeing the results of Federal Bank's change in strategy. But exactly the reasons that Vineet is saying, right? When you go to take a loan from Manappuram, whereas you go try to take a loan from SBI, when you go to take a loan, find a relationship manager, then the relationship manager will find a gold loan guy. He'll call him from a hub office, and then he'll ask you to bring the jewelry and put it on the desk right in front of everyone in the branch. So Manappuram, in this case, you'll have very small counters, like cabin like counters, and you'll show your jewelry in that cabin. So the operating model is very customized for taking a loan, and it's also very quick, like Vineet mentioned. So you get the loan in 2 hours. So the operating model is very different. But then what Federal Bank started doing is they started adapting this operating model and competing with Manappuram, next to Manappuram branches. So they started doing it in very localized fashion, and it's a small bank, and hence they can do it. And hence Manappuram started showing margin compressions, and obviously the stock price dipped quite a lot from 200 to maybe 90s or 80s, 120, and then 90s and 80s. But then I think if you speak to both Manappuram and Muthoot, the promoters of them, if you also listen to their interviews on ET, they would tell you that the total market size is quite large, and once a few small banks can do these localized experiments and put pressure in the market. And obviously everyone knows that gold loans are a very high margin, and hence a lot of banks are like trying to target this segment and trying to expand there. But both the promoters of Manappuram and Muthoot, on ET now have been very vocal that the market is like quite large in the long run. There's a lot of gold, which is stored in investors' houses and in jewelry, etc. That can still be monetized, and people can use that that asset and use it for other financial purposes. And obviously money needs to shift from gold to equity as well, and real estate to equity as well. So this market is quite large. Is that this is what their opinion is, and they feel that this market has like enough space for everyone, while Manappuram and Muthoot will try to keep capturing it. But I think then the key metric, the key watch list item becomes whether these guys are going to expand outside their comfort zone of South India. Are they going to expand more, and are they going to like keep expanding their business model you know uh, pan India, or are they going to stick with like their current geography? Because if they stick with their current geography, then obviously Federal Bank, if Federal Bank has figured out how to compete, then a few other South Indian banks and also maybe Equitas, etc., will start dominating the space in South India. So it's a matter of whether they actually use the large market that they have, or do they don't go that aggressive.
Thanks, Chetan.
Plus, Chetan,
And
plus
Chetan,
I think just a second, Prince. One of the main reasons also for the fall of Manappuram was not only competition. It was also because they had a big exposure in microfinance also. They are not a complete whole gold loan portfolio. So they had a 35% portfolio of microfinance and EEB business, and COVID gave them a hard time actually, and hence they saw a downtick on the stock also.
so next is Merit. You can unmute and ask your question, guys. Make sure we'll be wrapping it up by 8:30. So guys, make your quick questions and please respond in a limited time. We can extend it because Vineet has time till 8:30. So Chetan, we can take few questions after that. You can take those questions. So in the meantime, quickly ask. Yeah, Vajpayee ji.
Hello, can I ask please?
थैंक यू प्रिंस जी।
हेलो,
अभी थैंक यू विनीत जी ने और चेतन जी ने बहुत ही डिटेल में बैंकिंग सेक्टर के संबंध में डिस्कशन किया है, और ये मैं समझता हूँ जितने भी हमारे लिसनर्स हैं उनको काफी इससे हेल्प मिली होगी। बट मैं एक चीज कहना चाहूंगा कि क्योंकि देखिए फंडामेंटल्स एंड टेक्निकल दोनों का मिस करके ही काम करने से स्टॉक मार्केट में हम सफलता प्राप्त कर सकते हैं। तो विनीत जी ने बहुत ही डिटेल में फंडामेंटल्स के बारे में एक एक बैंक के संबंध में बता दिया, और एक बहुत अच्छी बात जो विनीत जी ने कही, मैं केवल उसी को रिपीट करूंगा, रिपीट कर लिया कि जो उन्होंने कहा कि एलिफेंट्स। तो मैं मेरी तो यही एक सलाह सबको रहेगी, सलाह क्या सुझाव का समझ लीजिए, कि आप जो है एलिफेंट्स के ही साथ में रहें, क्योंकि बैंकिंग इंडस्ट्री के अंदर की स्थिति जो बैलेंस शीट है उसको डीप स्टडी करना एक सामान्य व्यक्ति के लिए बहुत ही टफ होता है, क्योंकि जो लोग उसको ऑडिट भी करते हैं वो भी पूरा ठीक से स्टडी कर नहीं पाते हैं, क्योंकि इतना जल्दी उनको करना होता है। तो ऐसी स्थिति में जो बड़े बैंक्स हैं जिनको एलिफेंट के रूप में विनीत जी ने डिस्टिंग्विश किया, उनका नाम लेने की मैं जरूरत नहीं समझता हूँ, सभी लोग समझते हैं, तो उन्हीं में हम इन्वेस्टेड रहें और टेक्निकल पर्सपेक्टिव से भी देखते रहें, तो मैं समझता हूँ कि हमको कंटिन्यूअस उसमें ग्रोथ भी मिलती रहेगी और हमारा मनी भी सेफ रहेगा। क्योंकि जहां तक एथिक्स की बात है, एथिकल की बात है, ये बात बहुत सही कही विनीत जी ने भी कि इट इज वेरी डिफिकल्ट टू नो एथिक्स ऑफ द मैनेजमेंट। बट जिस मैनेजमेंट को आपने एक लंबे समय से देखा, तो उस मैनेजमेंट के बारे में आप एक व्यू बना सकते हैं कि जो 40 साल से 35 साल से उसका मैनेजमेंट अच्छा चल रहा है, तो वहां पर डाउट की संभावनाएं कम रहती हैं। जो लोग थोड़ा जल्दी में आए हैं उनमें मैनेजमेंट क्या कर रहा है अंदर से ये किसी को पता नहीं चल पाता। बड़े बड़े लोन्स के साथ साथ जो डाइवर्जन ऑफ फंड्स हो जाता है कभी कभी, तो वो बहुत प्रॉब्लम क्रिएट करता है। जैसा भी चेतन जी भी कह रहे थे कि DHFL का जब रेवेन्यू कलेक्शन शुरू होगा तो दैट विल बी मोर मतलब बेनिफिशियल हो जाएगा PL के लिए, और PL का जो सिस्टम है वो बेहतर है। तो चेतन जी PL चूंकि आज की कंपनी नहीं है, बहुत पुरानी कंपनी है, और मैनेजमेंट भी उनका एथिकल ही रहा होगा जब भी इतने आगे तक वो पहुंचे हैं। 3,000 रुपए तक का उसका भाव गया था, फिर वहां से करेक्शन में सब करेक्ट हुआ। तो कलेक्शन तो देखिए, कलेक्शन की प्रॉब्लम DHFL की उतनी नहीं थी, डिस्ट्रीब्यूशन ही जब आपने ऐसी जगह पे कर दिया और जब उस पैसे का साइफनिंग कर दी जाए गलत जगह पे, तो वो पैसा रिकवर नहीं हो पाता है, ये उनको पहले से पता होता है। बट अब हमको या जो भी वहाँ इन्वेस्टर है उसको नहीं पता रहता है। तो इसीलिए एथिक्स की जो बात आती है, तो एथिकल के पॉइंट ऑफ व्यू से हमें हिस्टोरिकली जिनको हमने लंबे समय से देखा है, तो मैं समझता हूँ उन्हीं में इन्वेस्ट करने से हमारा पैसा भी सेफ रहेगा और ग्रो भी होगा। बस इतना ही मैं कहना चाह रहा था, और उस पर टेक्निकल पॉइंट पर जरूर आप लोग ध्यान दें। जब भी कोई टेक्निकली वीक हो तो वहां से आप अपने आप को अलग कर लें, जब टेक्निकली साउंड हो तो फिर आप
अरे
उसमें
सर, ये आपने
वाजपेयी जी,
बहुत अच्छा पॉइंट।
चेतन सर सॉरी, लास्ट एक बार 15 मिनट्स विनीत के साथ क्वेश्चन करते हैं, उसके बाद वी विल कंटिन्यू द सेशन एंड ऑल द स्पीकर्स कैन आस्क क्वेश्चंस फ्रॉम द अदर्स। या मेरिट, यू कैन अनम्यूट एंड आस्क अ क्वेश्चन फ्रॉम विनीत।
I hold as some few bank stocks I hold, but I am always perpetually worried about growth of peer-to-peer lending, where they say that the interest rates will be very much less, and then cryptocurrencies, the effect on that, and there is China and Russia, they are creating one more currency as a rival to the dollar. How all these three things together can may affect the banking industry? Thank you.
So, Meritji, before we go ahead and talk about cryptocurrencies and the China, Russia, etc., we have to understand that peer-to-peer is something which is not a proper. I actually, just as a disclosure, I also do peer-to-peer lending. So I have seen the kind of NPS you get in peer-to-peer lending. It is completely unsecured, and though you get good yields, it is not a space where it can give competition to banks. And banks are somewhat more towards a large ticket size loan. Even if you go for a air conditioner, you will get 23-24,000 worth of loan, while in peer to peer the ticket size is very small, and there is a lot of risk in the counterparty, whether it will pay down or not. If you give a large ticket loan in peer to peer, you will lose your capital within months. So you have to do small ticket like 500 rupee loan and pool it with other peers and then give it, so that even if one loan goes bad, you are not impacted much. So I don't see any of these fintechs posing as a threat to Indian banking industry. I see these fintechs will become an enabler for creditworthiness for the banking industry, because these fintechs are actually creating data for the regulator, that which borrower is good and which borrower is bad, and hence it will help the banking industry in the long run. As far as cryptos and Russia China currencies are concerned, it does not impact in India, because India's regulations are not very friendly towards crypto. Uh, they consider crypto as a money laundering exercise, and that's why there is a check on all the exchanges also now. If you see recently, Indian exchanges have been having very hard time, crypto exchanges. That's primarily because government consider it as a money laundering exercise. So as long as that scene changes, does not changes, Indian banks are safe from any kind of crypto or digital currency moving around in the system.
Ketan, you can go next.
Jai Hind, Prince Bhai, and Jai Hind to all on the group, on the space. Vinit, just wanted, excuse me for if I have missed your conversation on PSU banks and specifically on SBI. I wanted to ask that is still there is a good room for SBI to say 3x or 4x from here, because if you see its annual report, they have almost 13-14 subsidiaries, out of which only two are listed: SBI Card and SBI Life. There is still value unlocking with almost 13 subsidiaries which are still unlisted. Uh, uh, and second, on ground level, I have seen SBI. Am I audible, Prince?
Yeah, you are audible.
And on ground level, I have seen SBI aggressively capitalizing on its AUM, on its book. For last 5 years, they are aggressively selling third-party products. They have entered into wealth management. They are hiring from from private sector banks, and paying high checks to the RMs, and pulling off a good AUM from the other private sector banks. And they are, I have not seen their revenue from the third party products in their balance sheet, but I have seen on ground for last 5 years they are very aggressive on the wealth products. So what's your view on SBI from here on?
So Ketan ji, I mentioned in my long 30 or 40 minutes of monologue also that PSU banks को जो valuation नहीं मिलती है वो इस वजह से नहीं मिलती है because people think that their underwriting is not good. Same is the case with PNB, same is the case with the biggest lender of the industry, which is SBI. My take on PSU banking is the underwriting process itself has some loopholes because when you are being governed by a government administrator, then you are bound to have exposure to politically exposed persons, and hence you are more towards going for a riskier bet than a cash flow driven bet. So that is why the valuations are lower. When we say there is an upside, yes, they are doing cross selling, they are doing good work. I completely understand and buy that. Their profitability is also on a rise because the credit cycle is changing. Their NPA cycle, the NPA cycle as a whole has come down, and hence they have a big large book which can give them an oversized returns. But if you look at the capital adequacy of SBI, it is always somewhere around 9.5, 10%. I foresee they will either raise equity capital or tier 1 capital through 81 bonds, and hence there is a limited amount of loans which they can disburse because of tier 1 capital. However, my concerns are still on the underwriting side because government of India considers SBI as their own treasury, and hence कोई भी पब्लिक मेजर लेना होता है, कोई भी फाइनेंशियल इंक्लूजन करना होता है, तो सबसे पहला नाम किसका आता है? SBI का. HDFC ICICI का नाम नहीं आता है सबसे पहले आएगा SBI से ब्रांच खुलवा लो, दूर दराज के गांव में जाके ब्रांच खुलवा लो, जो मर्जी कर लो, एंड जब लोन बांटने की बारी आएगी तो गवर्नमेंट जिसको कहेगी उसे लोन मिल जाए. तो वहाँ पर मेरे को थोड़ा सा चैलेंज है सरकारी बैंकों के साथ. जिस दिन ये लाइन ऑफ थॉट चेंज हो जाएगा गवर्नमेंट ऑफ इंडिया का, स्टेक होल्डर्स का इन द बैंक, then probably I'll be very pro toward PSU. I understand they are at a beaten down valuation. मैंने अभी PNB की भी बात करी थी. अगर कोई बैंक और एक PSU बैंक is trading at 4.4 time book value and it starts rising to 0.8 time book value, it still gives you a good return because it becomes double. But again, the business doesn't make sense to me considering the underwriting process.
Thanks, Vineet. And we have one last question for you from Shirinidhi. He has been trying since long. Yeah, Shirinidhi, you can unmute and ask your question.
Thank you so much, Prince. Hi, Vineet. My question is, what would be your opinion, not from a term percentage of valuation, but in terms of operational, advantages and disadvantages of the HDFC Bank and HDFC Limited merger? That's my first question. And second is, if you can just explain briefly to me, what do off-balance sheet items for banks and NBFCs pertain to, such as securitization and things like that, which they mention, from which they get in fee income? Thank you.
So, Srinidhi, I'll take the second question first. You mentioned about off-balance sheet items, right?
Yes, please.
So, off-balance sheet items are usually the derivative contracts which a bank executes on behalf of the loans, which are usually corporate loans for hedging their interest and currency risk. And hence, they have to consider the whole exposure of the loan and the derivative exposure as their contingent liability, which is off-balance sheet item. So this is a usual practice in banking industry. It is a part of the business and it has to be done like that, क्योंकि आप interest rate risk तब तक आप mitigate नहीं कर पाओगे जब तक आप derivative contracts के अंदर अपनी position नहीं बनाओगे, IRS swatch नहीं लोगे, तब तक आपका interest rate risk खत्म नहीं होता है. तो जब आप एक IRS स्वैप ले लेते हो, इट्स लाइक एन ऑप्शन. सो आप ऑप्शन, अगर आप 5 रुपए की भी ऑप्शन ले रहे हो बट आपका कॉन्ट्रैक्ट साइज तो 5,000 रुपए का है ना, तो आपको पूरा एक्सपोजर एज ए कंटिजेंट लायबिलिटी दिखाना पड़ता है.
Okay,
ठीक है.
thank you.
On the HDFC and HDFC Bank merger, I consider this to be one of the biggest things which is happening in the banking industry right now. Once it happens, it creates multiple challenges in the system. Number one, which I mentioned during my initial discussion, was HDFC will have to raise a lot of deposits from the market, which can create ripples in the banking industry. Once it gets garners the deposits, or once the merger has happened, there are SLR requirements, there are CRR requirements which they have to meet. They have been asking for relaxations from RBI on it. However, if they get it or not get it depends what happens. But deposit is something which is a very challenging thing to happen over a very short span of time. If they want 2 lakh, 3 lakh crore worth of deposits on their books to be raised, where the deposit rates are already on a very competitive side, it gets very difficult. So that's on. But once it is merged entity, the elephant becomes a mammoth. Okay, and once elephant becomes a mammoth, the pace also further slows down. So if you were growing at 20% for past 10 years, you cannot grow at 20% for next 10 years. Then your growth profile would tone down, and hence your valuation metric which you used to get will not be same as what you used to get 10 years back.
Okay, thank you so much.
So Vineet, are we good on time, or it's call for the day for you?
Prince, I'll have to call for the day because I've already been knocked on my door 2-3 times. So probably I'll have to call for the day.
Thank you so much, Vineet, for sparing almost 90 minutes for us, and it was really insightful knowing the intricacies which we need to see in banks and financials. And guys, this space is recorded, and you can also revisit in case if you missed any part of today's discussion. And obviously, we have so many queries, so we may try to arrange one session again, and perhaps those queries will be taken around that time. So thank you, Vineet, and any closing remarks or anything you want to say, over to you.
Thank you, Prince. A wonderful session. Chetan, I would like to be in touch. I am actively tracking banking space, so probably it's good to have great minds being connected. Small disclaimer, as I started the session with a disclaimer, I would like to close it with a disclaimer again. I am already an investor in few of the stocks which we have discussed. Please do not consider this discussion as an investment recommendation. This is just for sharing the knowledge, and since I am holding some of the banks, my views can be biased also. So please consider everything with a pinch of salt. Thank you.
Thanks, Vineet, and you guys can check the handle of Vineet, and if you like our spaces, so mine also, so that we can connect and you guys can get a feel of our spaces when we hold on various sectors, various topics, more or less regularly. So thanks, Vineet, and the remaining speakers can ask their question from Chetan, Pramesh, and even in my limited capacity, I would also try to take questions. And I see many people in the. So Abhishek, you can unmute and ask your question. Thanks, Vineet.
Thank you, Prince. Thank you, Prince, for hosting this space. So my question was actually for the experts over here. So they said like one of the reasons for switching from HDFC Bank to ICICI Bank was due to the retirement of Aditya Puri sir. And from what I have seen, like HDFC Bank is not doing that bad at all, not at all bad. But do you guys still consider that it's the magic is fading slowly away, or and it should be better to jump ships to ICICI Bank with that?
So, I mean, I don't think it was so when Aditya Puri, Mr. Aditya Puri left, right? The stock corrected about 8-10%. Obviously for good reasons, but I don't think there's like a management vacuum in HDFC Bank. They're continuing the strategy that was set, and they are trying to grow holistically. The switch between HDFC Bank and ICICI Bank happened because ICICI Bank, does not was not trading at a price to book of 4. It was like it was like a like a lower rung valuation, and they were showing signs of aggressiveness in the corporate book. And given the cycle last year, almost all experts could see that India domestic cyclicals would outperform and corporates would make a lot of money. And hence people started preferring corporate banks like ICICI Bank and IndusInd Bank. But the icing on the cake was that ICICI Bank's tech digital app and the digital API stack, or the digital tech stack, was much superior than HDFC, which means that they are set for like a 10-year growth period in both corporate and retail. And hence the valuation was very, very attractive for almost everyone. So I think the switch happened for portfolio composition and because of their tech strategy. And relative valuation was quite nice. HDFC Bank always used to trade at a premium, and hence relatively it looked that ICICI also could trade at a similar premium, if not slightly less. But yes.
Yeah, thank you. And they also say that HDFC Bank adds another HDFC Bank every 4 years due to the compounding magic. So would that still be the case going forward?
Yeah, so I mean, it is a magic of numbers, right? So HDFC Bank earlier used to compound at 25, then it's slowed down and is used to compound at 20. Now they're somewhere around between 15 and 20, but you can say 17. So they would, but in India you get uh, you know uh, 8-9% growth anyways, right? So they compared to the size, they're quite fast growing. But obviously they can do much better in terms of the digital app and the tech stack, and like collaborating with fintech, etc. So they have initiated a very large project to fix these things. I don't remember the name of the company. It was like like a fintech company, but quite a leader in this space, in the digital transformation space, that they've hired to fix this digital tech stack problems. If they improve it, then yes, I think it can still continue to grow rapidly, better than what they've done in the last 2 years, 2-3 years. They can start outperforming if that problem is fixed.
Okay, thank you so much. Yeah, thank you, Prince.
Abhishek, you go next, and then we go for Ramesh. Yeah, Abhishek.
That's me speaking, Prince.
Okay, my bad. I thought Kamlesh was speaking. So Ramesh, over to you.
No, can I speak? This is Kamlesh here.
Oh, good. There is a lot of confusion. Sorry, my bad. Yeah, yeah, Kamlesh, you can speak. Then we go to. Yeah, sorry, Ramesh.
Yeah. So I have two questions. So one, we've been discussing valuations of banks, and if you look at the HDFC's, Kotaks of the world, and ICICI has caught up, and valuations are close to now, 3 times book and all that. And assuming that the growth has moderated, as somebody said just now, that HDFC has come down from 30% to 25 to now 17, and maybe because of its size, the growth is going to fall further. Then the returns from these banks, assuming that there is no multiple expansion, is going to be muted, between 10 and 15% maybe. So is there sense to look at banks, where valuations, can re-rate, and the growth is there, and you can look at much higher returns than I'm sure this is risk adjusted return is also another principle, but I'm sure in the next 5 to 7 years these large banks will give moderate returns and not the 20-25% returns which a Kotak or HDFC has given for a long time. That's one. The second one, I don't know whether we're covering mortgage finance, housing as a sector, has
Hello.
started. Hello.
हाँ बोलो बेटा.
Yeah. So housing as a sector,
ना નથી લેવાય.
housing, has had its revival, and you see real estate companies, the real estate ancillary is doing well. Now, home finance as a sector, what are the thoughts of the experts on the panel here? And, which theme should we play, rather than HDFCs of the world, which is going to become HDFC Bank, is affordable housing finance a theme worth playing for the next 3-5 years?
Yes, I think both questions are quite on point. The first question about valuations being quite rich right now, and growth moderating is very on time question. Like the time to buy banks was 3, 4, 5 months ago, or a year ago, or like 18 months ago. But now the valuations are quite especially in the private banking space, they are quite full. You can argue that HDFC Bank, if they remediate their issues, then you can get a nice bump up for taking the risk. But like I personally have been reducing ICICI Bank, Bank of Baroda, Federal Bank from my portfolios, because I bought them quite a long time ago. SBI I've been holding for like 2 years now, but obviously because the forward multiple is very cheap in SBI, it's a forward price to earning multiple of 6, and price to book is 1.2. So still like only little undervaluation is left. But it's probably not the best time to go very aggressive on banks and expect like outsized returns. The outsized returns that should have come for the risk have already come in the last 3, 4 months. When the sector started outperforming, a lot of people jumped into the sector. So I think except for HDFC Bank, HDFC Limited, I think lots of banks have now come to a valuation multiple which they deserve. And now anything any further upside that you get are like added bonuses that you will get. um, but the nature of these things, you never know if the US recession and the Europe recession, because of natural gas prices, if it does not impact Indian exports so much, then you can expect 1 or 2 quarters of like more further upside returns. But then at some point, people will start calling that the valuations are full. And then obviously, they would start looking at in the tier 2 and tier 3 banks, especially what you're seeing in RBL Bank happening, and what you're seeing in maybe IDFC First. I don't track IDFC First, but I can say that like tier 2 banks or tier 3 banks have like started running, because people are starting to feel like at 870 ICICI is probably like decently valued, as an example. Not like amazingly valued, not like bull run valuation, but still like decently valued. And hence they you can see investor interest already in like the riskier banks and the riskier financial institutions. But I think that is what's going on. But if you have to look at the small finance space and the microfinance space, then you have to be extremely picky about the quality. And you need to compare, for example, an Equitas with an Ujjivan, and make up your mind whether you want to go with higher quality or lower quality. In MFI space, again, you'll have to like think about Credit Access versus Bandhan Bank, and you'll have to think about which one where am I comfortable, and that's probably like one area to make returns. But it's now going to get more difficult, I think. So the question is very, very relevant for these times. So it's probably not the sector to expect very dramatic returns from now on. So you can expect consistent compounding, consistent returns, but probably not dramatic returns. The time to make dramatic returns was probably like 6, 9 months ago, or a year and a half ago. I remember September 2020, people still were very skeptical about the banking industry, and the Bank Nifty had retested its bottom, while logistics companies and while sugar companies had like made a comeback. Banking was still retesting its COVID bottom. So probably that was the time to be more confident. And also the 3, 4 months ago. But right now, this is a sector which technical experts will tell you that this sector has broken out, which means that it has it has crossed full the previous full valuation periods. If So the upside from here will be like the riskier upside to go for. And Kamlesh, what was the second question? um I think the
Anyway,
second question.
Chetan, thanks for answering his question. He'll come again. So Pramesh has been waiting quite a long. Yeah, Pramesh, you can unmute and share your input or maybe anything you have.
Yeah, I just wanted to share a few very important points, and I'm hearing that the hearing about the aspect that the valuations have not necessarily peaked out, but they are at a significant maturity. So one would want to say that ICICI Bank isse upar kya jayega types. I don't look at it that way. You will have to look at each and every bank in a very granular manner. And if you see from a technical perspective, today Bank Nifty has made a golden crossover. If you see, which is golden crossover is the 50 SMA crossing the 200 SMA. So, and the price is also about that, which is a very good sign. So it looks likely that Bank Nifty may go for further speed up. There will be some hiccups here and there, but it looks likely once it has crossed a golden cross after a very long time, you might see after a few days or few weeks again a big bump coming up on Bank Nifty. So this is a space to watch out for. And if there are any dips, then based on each of your evaluation of banks, you should buy those banks. Like somebody said, very nice point on HDFC Bank in terms of what where bank is all about the jockey. So when your jockey is off, which is the case of Aditya Puri moving out from HDFC Bank, we had seen similar example with ITC. You all already remember at 2016 or 17 or 18 when Mr. Yasheshwar left ITC. The ITC had a lot of problems, but the new management slowly took over, and it took its time. And 2-3 years they have mended their ways. They have reallocated capital where they should be actually putting in, and now you can see how ITC is moving up. The same thing will happen with HDFC also. So you may have some time of moderation there in HDFC, but that would be a good accumulation space. You remember it's the largest private bank in India. So obviously it will take its time to come up, and yeah, the growth will moderate over there. But the premium valuation that was once there with the earlier management may not come in. It will take some time to come in. So that's on HDFC. You also need to look at banks in three, as somebody already mentioned, tier one, the largest of the banks. Then you refer to some of the medium market cap banks, and then something which are the upcoming banks. One of the good bank which I like and I am also invested in is IDFC. I am not invested in IDFC First Bank. I'm invested in IDFC because I believe that once the reverse merger happens, I will also get IDFC First Bank. And my buying price is quite cheap, so it's virtually free for me, the banks, when the reverse merger happens. So there are pockets over there. So we'll have to look at each of these banks and evaluate based on those pockets in terms of whether the bank is doing the right thing in terms of giving out loans. Are they growing their CASA? Remember this, in banks, everything is all about CASA. CASA is the seed material, raw material for banks. If that particular thing is not in place, that means the bank is borrowing at a higher cost from the marketplace, and that will affect their NIMs. So if the CASA is good quality CASA, take it from me, that bank will definitely do very well. As the next 2 to 3 years in India for the banking and financial industry is a very big boom. I mean, irrespective of whatever happens in the global things, whether there is a recession out there in some part of the world and all, India will grow domestically because demographically India is growing phenomenally. And I mean, in particularly, if you look at the salaries and all, they are growing at big pace. So I don't think so. Indian banking industry will be left out, or they will be starved of where to give the loans. So if the corporate is not working, retail will work for them. If the retail is not working, the SME or the corporate will work. Some or the other will for them will be working. And the banks are very swift. They know it very well. They have all the data to gauge this kind of movement. And they will, I mean, you already seen what HDFC is doing. Can you imagine they are going to open up some 1,500 branches, physical branches in the world where everybody else is doing digital? There is a plenty of reason for doing this. And that reason is because the geographic expansions of a lot of tier 1, tier 2 cities is happening far beyond anybody's imagination. So they need to be there at that point of time, at nearest to the where the people are living or residing. So that is the reason why SDFC Bank is expanding that big on physical branches. They are giving corporate loans. When nobody was willing to give, they have started moving more on the corporate side. They know better on this. Why are they doing this? So some of the things you will have to be little nimble footed. You have to be tracking those things and finding out where are the areas of growth coming in from. If they do, if a banking, a particular bank like IDFC Bank, it's what they are doing right now. It may not materialize today or tomorrow, but is it going to do after 2 to 3 years? Then stay in that bank, and I can assure you that those banks will really do well in the future. Because always remember, banking is all about jockey. You saw what Sandeep Bakshi has done to ICICI, what Vaidyanathan is doing to IDFC First Bank, or what Mr. Ghosh has done to Ujjivan. So the same thing applies here. Be on the quality side of the management. A CEO is in control of the bank, and if they are doing, they are walking the talk. You can track through their con calls and the results. Their CASAs is growing. Their loan growth is doing good. Obviously, you don't want the NPS to be in the range of more than 3% or 2.5% also. Then you are reasonably sure of good growth over there. And banks will definitely do well in the financial inclusion that is going to come for India in the next 2 to 3 years. That's what from my side, Prince. Thanks for hosting this.
Thank you,
Pramesh, can I ask you about IDFC Limited? I was also like evaluating this company, the holding company.
Yeah.
There was a change in chairman, right? The chairman was asked very difficult questions. I used to be an investor at that point because
Mr. Kakkar.
Yes, and he left, and now a new chairman has come. What is your opinion about the change of chairman?
If you see, the new chairman is Mr. Anil Sanghvi. If you remember, he has been one of the activist investor in many other companies also. And he has been on the board when Mr. Kakkar was already there. So he has been pushing for this merger, reverse merger. For the reverse merger, there are certain activities that needs to be done prior to that. And one of them, it's to do with what is called the holding company, NOHFC.
NOHFC, yes.
Yeah, a non-owned holding finance companies. So for that particular norm to be, for that reverse merger to materialize, they should not be having any other company other than the IDFC Bank. So they will have to eventually sell out all the companies like IDFC AMC and other IDFC foundations and a lot of other small little companies that they have, windmills and so many other things that they have. So that process in the case of Mr. Kakkar, to be very honest, was happening very slow. And this guy, once coming in, he expedited a lot of things. So we already seen as the IDFC AMC is already on sale. The transaction will go through.
Yes, it was in the news a few days ago.
The transaction is going, it may happen anytime in terms of the actual transfer of money. What they do with this money is a big question where IDFC First Bank will also play a role, because whether if the money is given in the form of dividends to the shareholders, typically 15, 16 to 18 rupees will be coming in. That will be quite a money in terms of taxable nature. Yeah. Or if they give that money to IDFC First Bank if they want, for augmenting their Tier 1 capital. This is all discussions which they have to do at the management level. So difficult to say what they will do. But these are the alternatives that they might. And for that, I think so they have already they have hired an external consultant to guide them on this particular aspect. So a decision will come whenever, very soon is expected on that. So once that happens, then the IDFC First Bank management will have to decide on the merger part. So that is a very big step. It's a sensitive step also, because whatever said and done, at the end of the day, IDFC is the holding company for IDFC First Bank. Government of India is also having their stake of around 9% in IDFC holding company. So they will also have their say. So it will take its time in terms of management, swap ratio. There will be contingent liability issues also. All those things, once the swap ratio is materialized, which from a share perspective, it is 1.42. So for every share of IDFC, you will get 1.42 shares of IDFC First Bank. But after due course of some negotiations and the fair valuations by an appointed consultant, I personally expect it to be around 1.35, around that area. So that, but all this process will take a lot of time. It is not going to happen in the next 3 months or 6 months. So, but Anil Sanghvi, I think so, or Mr. Kakkar has given one deadline of 2023, March 23, that whole transaction to get complete. So I think so, Mr. Singhvi will also stick to that. Looks likely it will happen by that time.
So thanks, Pramesh. Chetan. We have one last question from Sample Investor, and after that we'll be closing it. So Sample Investor, you can unmute yourself. And guys, a short disclaimer: any names taken by any of the speakers during the conversation are purely for educational purposes. They may or they may not have any positions, or maybe their views can be biased. So we would request our audiences to take their views with a pinch of salt, to your own study before making any investment advice. So that would be on your part. Yes, Sample Investor, you can unmute and ask your quick question.
Yes, thank you, Prince. I just have a simple analysis, which I want to know your comments on that, because of late I'm quite hearing a lot that HDFC might not be doing a good thing, that they are opening branches a lot, but I think they are doing a very good thing, because I basically come from a tier 2 city, where where tier 2 cities are mostly dependent on small businesses, where this HDFC bank can strategize their branches so that more current accounts and more savings accounts can be opened over there. Even now they are in good position, but I feel with the current branch expansion, where in tier 2 cities, I agree that people prefer internet banking, but still their human relationship matters a lot for them in tier 2 and tier 3 cities. I think they are doing a very good thing, but I'm not sure why the experts, or why the stock is not considering that thing. Yes, I understand the merger may not turn out how it is supposed to be, but yes, I think that's a very good thing that they are doing, which others are not doing right now.
Okay, so I think I'll break this question into two parts. I'll take the second part first. That you think HDFC is underperforming because of the branch expansion, and then I'll go to branch expansion. Actually, HDFC Bank has been underperforming for two reasons. One is that India typically used to have like 70% FII and 30% DII retail composition in the market. What happened is, like, when the US dollar started getting strong, and emerging market desks of all of these FII people were told to withdraw from emerging market currencies, then they basically sold off all their emerging market exposures. So you can like check stock prices in Brazil as an example to just figure out that this is happening everywhere. And so as part of that, FII's largest holding was HDFC Limited and HDFC Bank, and also to some extent Reliance and ICICI, but HDFC Bank was like extremely overowned by FIIs. So that was like adding to a lot of pressure. Plus, at that time, there were also many articles about the digital app of HDFC Bank not really performing. That was another reason. And then Aditya Puri had left, etc., etc. So like investors were not really looking forward, and they were just looking at the short term news and short term flows to just take punts that HDFC Bank would not perform compared to the market, because lots of exposure is owned by FIIs, and then they'll continue to sell. So that was one. That's why it was trading around 1250, 1280. Even when other banks were doing decent. Now it has crossed 1450, etc. But that was the main reason. The FII flows and the over ownership by FIIs was the main reason for HDFC Bank and HDFC Limited to underperform. Then there were five or six more reasons. This branch opening of 1500 branch was not even like in the top 10 list of concerns. But what you highlight is quite important, that HDFC Bank is a retail plus corporate bank, right? And then it's a really good mix of both. And then if you open a branch in a tier 2 city, and I also come from a tier 2 city in Maharashtra. I now live in London, but I go to India like twice a year and speak with my HDFC relationship managers and Kotak relationship managers. But then you can see that HDFC Bank has a significant advantage over both public sector banks as well as the other private sector banks, like significant, because they spend a lot of time with the relationship managers, and they give them quite aggressive targets. Yeah, I have to call them aggressive. uh, but they are also like well managed. The branches are much better managed than ICICI and better managed than Kotak as well, on top of SBI. The underlying thesis of any fund manager in India, any FI investor, any domestic investor, is that over the next 50 years, SBI, Bank of Baroda, Bank of India, Indian Bank, all the other 20 public sector banks will lose market share to the three private bank sector banks or four private sector banks. That's the main thesis of investing in private banks. And HDFC having this like strong, like very long, history of running branches, they are very very good at it. They're not a new bank; they're very very old bank, private bank, and hence they run their branches very very efficiently, setting the targets very efficiently. And then when the retail CASA base is built, and also the corporate current accounts have been built, they get an added advantage that the people who have strong businesses in that city prefer to have their accounts in HDFC Bank compared to even the other public sector, private sector banks, because how well the branches are run, how well the number of tellers is managed, etc. So it adds to a lot of returns for investors in the long run. It takes time, but it adds to a lot of return. So assuming that these 1500 branches are being set up in really good cities where they would have like a good mix of both retail and corporate, and where indeed there's a demand for high quality banking, high quality in person banking or personal relationships with the bankers, assuming that they have done their due diligence on selecting these branches, they will do very well, marvelously well. There's no doubt about that. The main concerns are FII flows, and the other concern is actually their digital app. So for the new age generation who are not using branches, they don't really like the HDFC banking app. That's like a consistent feedback. And they are now overhauling it, and that project is like started 3 months ago, and it's supposed to end in the next 6 to 9 months maximum. So the result of that is like the prime tracking thing. And the other thing is like how well do they actually build their tech stack compared to ICICI, who has already built their tech stack. So when ICICI Bank has to onboard a fintech, let's say to do a co-branding credit card, or let's say to add a new fintech to their payment suite, they can do it much much faster compared to HDFC, because all of their APIs and all of their tech stack is written so that they can be shared with fintechs. So basically they can onboard fintechs much quicker, and hence in the long run ICICI is set like for massive gains because of that. So if you are able to track if HDFC Bank is actually solving the digital app issue of how nice it is and how nice the digital flows are, and secondly how nicely they can onboard fintechs compared to ICICI Bank, if they solve those two, then they'll do really well, and they'll go back to their premium valuations, HDFC Bank. But those two are the big monitorables, and I think FII flows have now reversed. So the top issue is already addressed.
Thanks, Chetan. And I think this answered question from sample investor. It was very elaborate one. So guys, we are calling it for the day. So thank you for joining today. And I would request you guys, if you are liking our spaces, kindly connect with our handle so that in future also when we hold some spaces from different sector experts, and within the attendees, most of the time we found a new gem who has their side of story and their side of experience they share with us. So it's a two-way communication. It was really nice finding many people within the investing community, Ramesh, Yogesh, and today we interacted with Chetan, and even Ketan is very good with the questions. So with this, I request your leave, guys. But I would once again reiterate: this space has been recorded. Those who joined late or those who want to revisit what we discussed today, they can go for it. And again, we are not into any commercials. There is no sort of endorsement for anyone. we bring in the best people we know in our network and try to share the knowledge best in our capacity so as to grow together, because we are a student of market, and in market it is up to us what we learn and what we do with our temperament and all. So Ketan, you came again, but guys, a quick 30 seconds for you. I'll be closing because it's already late for me.
Prince Bhai, hats off to you. The way I don't miss any of your space, and if in case I miss, I am glad that you recorded to go through these spaces again. So hats off to you. And I just wanted to add 2-3 things. One was for the Piramal Enterprises. I am an ex-banker, and I am into loans. So I have seen post COVID, Piramal was into big trouble into his books. They were the book was highly lended towards the builders. Builder funding was too huge. They had trimmed the loan ticket size to 50 lakhs and 25 lakhs. The pain is still in the book, though it's a big name. They have the promoters themselves are cash rich, so they have pumped in the money. They are still reviving the businesses, but still there is a pain, and the ticket size, the loan ROI is still higher than the market rate. So this is one of the update. Second, the ICICI, the app part which Chetan highlighted about the HDFC, that is the real pain for HDFC, and ICICI is much ahead. They have their own in-house tech team. If you compare with the other banking apps, ICICI is one of the bestest app wherein you can get each and everything. You don't have to go to Paytm or MobiKwik or any of the wallet. You just open. Even if you don't have an ICICI bank account, then too you can create an account with ICICI bank, downloading the app. And the Insta business app which ICICI has, you might have people might have gone through the advertisement also. They are so aggressive that non ICICI customers can even avail a credit facility from that app. So these were the two updates from ICICI and Piramal. And I have disclaimer is I am invested in SBI since long. My average is around 250 because I had asked a question to Vinith at that time, and ICICI also I am invested. I am not invested in Piramal. This was the disclaimer. Thanks a lot.
Mr. Ketan, Mr. Ketan, can I also ask you about Piramal? Do you think that they have learned their lesson about lending to Lodha Group and real estate, and they are now going towards retail granularizing? Do you think they have learned their lesson?
Everyone is a learner at any age of point, whether it's a company or a promoter or a investor or anybody. So they have learned their mistake. They are trimming why they buy out DHFL. The reason was the DHFL was more into retail. The retail book was good. There are the DHFL, the NIMS, the net interest margin, since they invest, their customers were from 2-tier, 3-tier cities where their ITRs are weak. They know that they will repay the loan, and even till date, from now, if I speak about now the rate of interest are say anywhere between 7.8 to 8.1. Still you will see the Piramal or the any other NBFC type of banks, they are still charging 9 and 9.5, 10 for a home loan. See, Piramal book will.
Listen. Sorry to come in between. So you are like our Karan and Arjun for our today's spaces. I thank you both, but I request your leave for a reason because I'm already late on my dinner by more than half an hour, and it's my family time. So I request you guys. Surely we will connect again, and it was really insightful to get anecdotes and knowledge from Chetan and Ketan also. And thanks for the appreciation, Ketan. And it is very nice of you to attend our spaces. It's, as I say, two-way communication. We all learn from each other. So thank you so much, guys. I call it for the day, and do connect with our spaces. Do check our handles. You will find a number of recorded spaces, and trust me, guys, it's not about like I'm endorsing myself, but the people, the expert which are coming to our spaces are very knowledgeable and have immense sector knowledge, 2 3 decades or maybe more than that. So you guys will cherish every moment. So I will request you to have a look. If you find value, you can connect, otherwise you can give it a pass. So with this, I take your leave.
Prince
Thank you for
bhai,
coming, and do come in next.
Prince bhai, one thing I would like to add to the people on the space, please go through, it's not again any endorsement, but you go through the handle of Prince. It's worth listening the recorded spaces of Prince. And again, hats off to you bringing the most of the gems on the spaces.